You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Thank you, Jim, Deanna, Andrew, and Jeff. That was very enlightening. I'd like to remind everyone and encourage everyone to, again, download the app. Our next session will have some slides, and all of the presentations, including that one, will be available through the app. Now, I'd like to introduce my friend, Henry Schwartz, the president of Trade Alert, which is the leading provider of securities market intelligence to all types of financial professionals. Henry has held institutional trading and management roles with Bank of America, Bear Stearns, Salomon Brothers, and the Hull Group, and made markets on the CBOE, the Amex floors in the U.S., and Eurex and Monep overseas. He also actually happens to be one of the very first ISE PMMs back in the year 2000 with Bank of America. This is before they combined with Merrill Lynch, and it's my understanding he made hundreds of dollars engaged in that activity. Prior to founding Trade Alert, Henry led the electronic market making at Bank of America. He holds a master's degree from NYU Stern School of Business and a bachelor's degree in economics from the University of California in San Diego. Henry will provide an analysis of the industry and where we stand today. Please join me in welcoming Henry to the stage.
Thank you. Okay, thank you, Boris. And yes, we were very proud to turn on our bin on that very first minute of, I want to say like May 15th-ish in 2000. I don't think we did a trade on purpose for months after that, but it was an important part of this industry. I started almost 30 years ago as a runner on the CBOE when there were runners, and I've been lucky enough to bounce around. I did market making, I did electronic market making overseas, traded for banks, did the ISE market making, and then almost 10 years ago started Trade Alert, which is an option data firm specifically to deal with kind of some of the issues that are going on. And I will point out that is 7 times more jobs than Boris has had in his career. So let's get going. We're going to talk about growth. We're going to talk about the participants in this industry. We're going to talk about what's hot right now, and we're going to talk about what I see as kind of next for the industry. So we're going to start with the graph that I think, if you've been to a bunch of OIC conferences, this is the first chart at every single one of these. I tried to make it a little bit sexier with putting some exchange logos on to point out where the new exchanges popped in. You can see that it was kind of static for about 25 years until the ISE started in 2000, and they're the lead sponsor for this conference, and I think it's very important to really appreciate kind of what that did for this market. You see that the growth is effectively exponential for a while after that point. There's other things going on, for sure. Decimalization is one of the big things. Penny pilot, all those other things come into play. But the growth has been huge. I mean, over the last 40 years, annualized growth, well above, 12, 13%. Over the last 20 years, same deal. Things do start to slow down, and over the last decade, we're looking at 8% growth overall, and over the last 5 years, 2% growth, and that's why I kind of outlined the last decade, because what I'd like to do is kind of zoom into that modern history of the options industry and try to figure out what's going on. And I don't think anybody's super thrilled about that growth. But when you kind of zoom into some of the detail, there's some very interesting nuances to it. So this is the last decade of growth of option volume broken into ETF index and single stock. You can see that ETF growth has been huge, 10%, over the 10 years. and pretty solid over the shorter terms as well. Index growth as well, same deal. It's pretty strong and it's pretty positive. When you get down to the single stocks, things are kind of stalling out. We have basically volume declines over the last couple of years, and that's something that I don't think too many people are happy about. Overall we still have positive growth, but when you look at the product growth, okay, you can see basically the number of ETFs with options on them has more than doubled in the last 6 years. Indexes have been cut in half, which is kind of refreshing to see the exchanges just delist the stuff that nobody was trading, nobody wanted to quote. And the single stock listings, we've picked up almost 1,000 new stocks, but that doesn't seem to be attracting the volume in those stocks. If we go on to contract growth, this is what's kind of amazing and has a lot of impact. Over the last 6 or 7 years, this is about 6.5 years, the number of listings has gone up by about 30%. The number of options that you can trade in our markets has tripled from 300,000 individual contracts to 900,000 contracts. At the same time, over that exact same interval, you have the number of exchanges that are trading these options doubling to 14. Okay, that's an enormous demand for resources, for participants, market makers, basically everybody in the process, from the exchanges down to the broker dealers and the vendors in the middle. Most of that is coming in the equity space. Most of those new contracts, obviously we have weeklies have come on, and I'll show you a slide on that. Dollar strike pilot, but you've come into a situation where there's just an insane amount of information that needs to get around, and an insane amount of complexity in terms of routing orders and optimizing that part of the process. Market growth, everybody here is intimately familiar with this. 14 exchanges. We used to have when I was on the CBOE floor, we had a cheat sheet for fractions, right? Because you had to remember 17, these was 0.4375. And this is my cheat sheet for the exchanges. When people say, well, why are there 14 exchanges? There's usually a panel on how many exchanges is enough. What you see basically is it's all fee model related. Why does the ICE have Amex and ARCA? Well, the blue boxes are payment for order flow models. The orange boxes are the maker-taker pricing models. And there's differences in some of the details, but not that much. And the pie chart just shows you, more or less half of the volume goes to the payment for order flow fee models, and half of the volume goes to the maker-taker models. And basically, each exchange operator wants to be going after both of those sets of volume, and that's what you have. I do think now with the ISE family of exchanges most likely merging with NASDAQ, you do have some real redundancy there, and it'll be interesting to see if they decide to keep operating all those exchanges separately. I think things will change this year for sure, though. Looking at market share, okay, on the left was when there were 5 exchanges, and basically the ISE is the kind of brownish color, and the CBOE is blue. They kind of had the lion's share. ISE in single stock, CBOE has always been about half index. But what's kind of wild is this is over the last 10 years, you really end up with a pretty even split. I mean, even these new exchanges that have showed up in the last 4 or 5 years have very quickly come to 6, 7, 8, 9% of the market share for volume, which to me tells me that there's not a ton of difference, especially from the end user standpoint. In fact, my job involves running around to different banks and kind of showing off our system and showing people how to use new features. And when Mercury launched, I was at a bank, and I'm like, okay, well, these are what the Mercury trades are going to look like, and here's how you can recap the biggest trades on Mercury. And one of the senior traders there looked at me, he's like, what's Mercury? I'm like, well, it's the new exchange. He's like, oh, I don't really need to know that. And so, people are relying on smart routing and kind of that part of the process to take care of the decision on where things are executing in a lot of cases. Looking at market share for last month, on the left you see basically what I was talking about. It's reasonably even split. Okay, SIBO's still kind of double most of the competitors, with half of that being index. But it's just kind of a relatively even playing field as far as the exchanges go. And then on the right, if you break it up by the exchange operators, it's a slightly different picture. You have the NASDAQ complex, assuming that they finish acquiring all the ICE exchanges, really is kind of the dominant force in single stock, which is very interesting because it's kind of coming out of left field to a lot of people. Participants. I don't think you can read. Maybe you can read some of those. When I showed this to someone in my office, they said it looked like a Death Star with Susquehanna in the middle. And I don't want to offend Susquehanna because I like that firm a lot, and they're valuable clients. This is all 173 13F filers that had options on their 13Fs as of December. And the size of the font is roughly related to how many contracts they had, how big their piece of the overall open interest was. And it is very interesting to see. Susquehanna is honestly about 25% of the overall market open interest. So they are a huge, huge player. And although if I change the plot so it says Susquehanna, then it messes the whole thing up. So, but I'll show you another slide related to the holders of options. But you can see the bigger names, and this is kind of a better way to look at it. Actually, the next slide. This one actually is one of the most exciting things that we're seeing in the data. So this is the number of 13F filers with options on their book over the last 14 years. A really nice, steady uptrend, which tells you there's more and more individual firms with large enough option positions to report them, which is $100,000 in notional, I believe. Seeing this is kind of one of the most exciting pieces of kind of where are we going next, because it's almost a straight up increase year over year. Looking at the market makers for a minute, this chart is set up so that the size of the ball is, by my calculation, how many markets they're quoting on, how many exchanges. And I know I'm missing some, and there were a few cases where I had to make some estimates. But in general, Susquehanna, Wolverine, quoting all 14 markets. The other big guys, 13, 14, or 12 or 13. If you had, this is it. It's about 26 firms, and we're missing some of the single exchange groups. But if you're looking at this equivalent chart 20 years ago, it would be much more, many more circles and a lot smaller firms. And this is kind of a consequence of a number of things. But the evolution of the market to where it is now, where it takes intense technology to quote, especially if you want to quote 14 exchanges. In fact, I was talking to Blair Hull, who's my first employer a few years ago, and I said, would you guys ever, would Ketchum ever think about getting back into the equity option space? And he looked at me, he's like, I'm not going to spend $25 million a year to compete in that market. So that was a few years ago. It's probably more than that now. But it's very much a big boys game. There's a lot of, this is my gripe session part of this presentation. All these incremental innovations which have come about because a customer asked for it, or because somebody thought this would improve the execution and the experience for the customer. Everything from auctions to preferencing to QCC, on their own, they were the rules were approved, so the SEC was okay with it. But every market maker that I talked to in trying to get ready for this was just like, you can't believe the bullshit and the cost that has never been around before. One down on regulation, one shop in Chicago told me they now have to get all of their traders registered with Series 7s. They've never had to before. They have over 100 traders. He said that it costs a ton of money, and he's like, and what is the point of getting a trader who doesn't talk to a customer, who is a professional and his whole job all day long is managing risk and doing the right thing, to kind of go through these hoops to be registered like a registered rep who does need to talk to customers and needs to needs that supervision to make sure they know what they're talking about. So it's a really tough time for market makers, and I don't think that's a healthy thing for the market. It's I know you can't roll back the clock, but I think that the overall market needs to kind of appreciate the value that the liquidity providers are doing out there. And I mean, when I was at both of the banks I worked at, internalizing orders, I was definitely one of that was what we did. We cherry-picked as much as we could. But at the time, it was like, well, okay, fine, we'll let the floor do half, and we'll take half on the book, and we'll manage it from there on. We've moved beyond that, right? QCC lets the upstairs firm cross the whole thing with absolutely zero interference from the floor. And I know the logic for that was, well, it was already being done on the Philly, so you want to have an electronic version of that. But what you're doing is taking away the positive order flow for the market making community, and they're left with this negative selection problem, which is makes it really, really hard for them to survive. So, and then you start seeing what we saw, which is the numbers go down and the market quality goes down as well. Don't worry, I'll get more positive towards the end, though. Let's talk about what's hot. We obviously have a very, very concentrated market. Over 4,000 underlyings, but only about 130 of them together trade the top 80% of the volume. So you have out of 4,400 underlyings, you have 1,000 stocks with average daily volume less than 10 contracts. And this is where the focus is. This is where the liquidity is. This is where the customers are trading. However, I think that one pension manager that I spoke to, his biggest complaint was that so many markets are so wide, and that opens the door for an upstairs firm to offer an OTC trade at what seems to be a much tighter spread, and that's happening. In fact, somebody else that I talked to at a bank I used to work at, when I said I'm going to do this presentation and tell me what's going on and what's good in this this market, and he said, oh, well, commissions are down about 15-20% for the big producers, but we're doing more OTC than ever. And I said, okay, that's not positive for me. But I think it's important to understand, because that stuff is really hard to spot, and it's going on, and you get into this cycle where, well, the markets are really wide, so the customers really only want to trade OTC, and that's why the market makers aren't going to tighten up their quotes. New expirations have been a huge positive for volume. This is the weeklies and quarterlies and monthlies, pretty much since they were rolled out in 2010, and the trend line on the blue section is the weekly option market share, which is now over 33% a day. In some products, in Apple, it's about 45% of the average daily volume is weeklies that expire within a few days or within 10 days. The quarterlies also have their moments. So this has been a huge success, and I think a lot of people were kind of uncomfortable with these short-term weeklies when they rolled out, but you got to give the people what they want. And I think actually, as much as I consider them to be kind of a gamma time bomb, the market seems to have gotten used to trading them, and the participants, I think, are able to manage that risk okay. Complex orders is another very very positive uptrend. Over the last, this is 8 years, from about 22% to about 33% of the option volume now is in the form of complex orders. And this is huge. I mean, this is actually where there's still a lot of potential because there's still some pieces of that puzzle that aren't put together. But you have things like the ISC's implied orders, which will leg out the individual legs when it's possible. You have the complex order books on about 5 of the exchanges, which just make it very easy and seamless to trade them. And in fact, when you look at the volume, the market share of complex orders for exchange, on the ISC, it's 59% of their total volume is trading in the form of complex orders. It's half the CBOE volume. It's half the Amex volume. So complex orders, are important. Customers like them. They're becoming easier to trade through front ends, through vendor products. There's even some firms that will kind of leg across exchanges for customers. There's some work to be done there. But you don't have the situation anymore where, bid to offer, the thing was at $1, so I tried to bid $1 for this spread, and I just didn't get a fill. You still do have situations where they get split up to go to different exchanges because nobody can quite tell where the fill's going to come from. But the execution quality of the complex orders has gotten a ton better. Flex options is another area where we're seeing some growth. The numbers are not huge, but we could hit 30 million flex contracts this year. It's less than 1% of the total volume, but it counts. What's important here also is that the flex volume is growing in this equity options as well as the ETFs and the indexes. So there's some big positions out there. I mean, EWZ, that 2 million contracts of flex open interest as of a couple weeks ago is twice as big as the listed open interest. So there's interest there. The CBOE just rolled out Clique and Asian Flex, and I'll tell you, the Asian Flexes are trading every day. The numbers are little. It's 80, 90, a couple hundred contracts here and there, but they're every single day. So the insurance companies that wanted them are trading them, and I think there's opportunity there for they're only traded on CBOE, Amex, ARCA, Philly. And I think there's a lot of opportunity there. I think there's a lot of opportunity there to fight for some of that OTC flow that's going away. Let's see, what do we got? This is another important and very positive slide. The realized bid offer. Okay, so here's 4 pretty liquid names, and what you're looking at there is basically the double the spread paid by customers on trades. So it's the bid offer as far as a dealer side would be compared. That lower line, basically where it hung out for about 4 years between 2010 and 2013, is 2 pennies wide. So a penny wide, a penny of edge, if you're thinking in market maker terms, doesn't leave a lot of room to make money. Doesn't leave a lot of room to basically finance all the technology that's required to be a market maker. And I was at a interdealer broker a few months back and talking to him about things, and I said, what's going on? He said, spreads are really widening out. And I said, that's bad. And he's like, no, that's good. The spreads were so tight that nobody was making any money. Everybody was miserable to be trading. And the customers really don't care if it's a penny wide or 2 pennies wide. And so to see these spreads widening out, and this is not, volatility obviously plays a part, but this is not where this is coming from. To see the spreads widening out is a very positive thing for kind of the business. And most importantly, somebody at an exchange told me that they're actually seeing some market maker applications show up for the first time in years. And that's what you need, is you need some new blood to come in. You need that cycle to kind of resume, which is some market makers come in and compete, and the market, the quote quality goes up, and customers are more likely to trade, and volume goes up. So that was a positive, very positive thing to see. So let's look at what is coming next. Okay, cocktails are really next. That's important. I think that volume growth will pick up, and in fact, on that very first chart, the pace of growth dropped off after the '87 crash, went negative, volume went down for 4 years in a row. The pace went down after the dot-com bubble in 2000. And this 2008 financial crisis, was a big deal, obviously, and I think we're still kind of in the hangover phase of that. In each one of those time periods, it took about 5 or 6 years for growth to kind of resume. So I think that volume will pick up purely in the stabilization of what the banks are allowed to do. Once the deleveraging of the hedge fund world kind of stabilizes, you'll see new participants and new growth. Complex orders, I think that there's no reason why it shouldn't be 50% market wide, and that should be new volume, because in a lot of cases, customers wait for a trade to expire before they go and put it on again. And when complex orders and rolls become turnkey and easy, then they'll roll trades. So you get that volume twice rather than the one time. And the complex order book capabilities are still now I think a lot of them can handle up to 8 legs and get pretty fancy with the packages that they'll support. But you also see this trend of idea generation and backtesting vendors in the space. SIBO's investment in trade legs is a good example. Optimizing what's really the right trade for me and for my purpose, and it is a spread in almost all cases. That's a whole new way of doing business. I mean, it astounds me. Given kind of the evolution from, screaming guys, yelling at each other and putting tickets on a belt, to, the, millisecond execution, sub-millisecond execution that we have now, the trade selection and execution in a lot of cases for institution is still stuck in the, if not the 80s, the 90s. So to see people taking a quantitative, intelligent approach to, okay, what trade actually is going to do what I want it to do, and also backtest what if I did this, and actually, for people to start trusting that, will bring more volume into the complex orders for sure. I do think we're going to see some consolidation this year. I just think that we kind of got to the point where a new exchange is not adding a ton of value to the process, and in the end, the process is getting costly to kind of handle that. I hope I'm not making enemies there. New sources of liquidity, new market makers coming in, new participants, because of the widening spreads for the liquidity providers for sure, and just because of the technology marching on, the fact that it is easier to do things now than ever kind of in the past in terms of technology, I think will bring new sources of liquidity, and then that slide of the institutional user count going up year after year, I don't think that's going to slow down. I do think we need to be careful to make sure that they stick with listed derivatives. It was very interesting to hear the regulator kind of mention the concept of a unified view between equities, where TRF is kind of the way business is done, and options, where we fight very hard to make sure that's not the way business is done, because we believe that transparency is the way to go. I think that's where people need to be very, very strong in pushing for what makes keeping this market as good as it is. So thank you, and we'll see you guys later. Finished early, and Boris is probably in the bathroom. Oh, hi, Boris.
Thank you, Henry. All right. Thanks, Henry. Thanks, all of the afternoon speakers. This concludes the general session. Everyone, please join us in the exhibit hall right over there for some cocktails. And the reminder, the exchange dinners at 6 p.m. at the Terranair Resort pool over that way. Thanks very much. See you in the morning.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.